Hi, good evening, everyone. My name is Gerald, and I'll be sharing more about Singapore REITs during tonight's webinar. I think over the past few weeks, we have seen very big movements in the share prices of the Singapore REITs as a result of the tariffs that were announced in the US and various macro developments that came through as a result of that. So what I'll do in tonight's session is to go through some of these developments, look at the fundamentals of the Singapore REITs, where the valuations are at this point in time, and from there, share some of the key things that I'll be keeping a lookout for. So just as a quick introduction about Beansprout, we are a financial insights platform licensed by the MAS. My name is Gerald. I'm the founder of Beansprout. And together with my team, we would be sharing with you our insights on not just Singapore REITs, but also other stocks within the Singapore market. You'll probably see some of our updates on, say, the Singapore T-bills, fixed deposit, savings accounts as well. So we hope to be able to share some of these insights with you and help you make better financial decisions. Tonight's sharing is for informational purposes only. So while we'll be sharing particular REITs in tonight's webinar, they are not specific to your individual investment objectives and risk appetite. So if you want to understand whether these securities are suited for your investment objectives and risk appetite, do consult your financial advisor. There are a few key things that I wanted to go through tonight, and these are probably the key questions that you have at the back of your minds. So first and foremost, what is driving this volatility in Singapore REITs? They are supposed to be stable investment assets, but over the past 2 weeks, we have seen fairly big movements in the share price of Singapore REITs. So we'll go through some of the reasons behind their movements. Next, as a fundamental analyst, I always want to look at what are the outlook like for the different REIT subsectors to understand whether the share price movements are actually justified and whether this will then create opportunities for us as investors. Last but not least, we hope to be able to share some of the key things that we will keep a lookout for so that we can keep this session meaningful and fruitful for everybody, and we will know what to continue looking out for even after tonight's webinar. Okay, then we'll have some time for Q&A because I'm sure you have some burning questions on the Singapore REITs that you want to be asking as well. So I think what I will start with is to really look at what is driving the very big movements within the Singapore REITs over the past few weeks. So maybe just to use a broad-based index of Singapore REITs as an example, I brought up the CSOP IHS REIT ETF, which is an exchange-traded fund tracking an index of Singapore REITs. And what I wanted to share from this chart is really how the Singapore REITs have moved as a whole over the past few weeks. So if you've been following our webinars on Singapore REITs, I think I've gone through the reasons behind the rally that we saw in the fourth quarter of last year. That was as a reaction to the expectations of the Federal Reserve interest rate cuts. Thereafter, we saw the share prices of the REITs coming down. We held a webinar in November last year just explaining that even though we have seen the REITs cut, the US Fed actually cutting the interest rates, actually we have seen the bond yields moving up as a result due to expectations that the inflation may remain elevated and the Fed may not be able to cut interest rates as aggressively going forward. So this is what we have seen in the early part of 2025. After the rate cuts by the US Federal Reserve in the fourth quarter of last year, they have effectively stopped on the interest rate cuts in 2025. Okay, and then what we have seen over the past few weeks, starting from March, is that because of a lot of the news around the US tariffs, the share prices of the REITs have reacted as a result. So what we saw here is that initially there was some flight towards the Singapore REITs when the tariffs were initially announced. This was because the REITs were initially seen as a safe place to hide with the uncertainty on the global tariffs. So we saw this bounce in early March for the REIT sector as investors started looking for safe places to be hiding within the global markets. What we saw next is this very sharp fall that actually happened last week. And this is really as a result of two key things that have happened. First, we have seen actually US 10-year government bond yield and also the Singapore 10-year government bond yield moving up very sharply. So while the bond yields had initially declined, we actually saw a very big move up in the 10-year government bond yield in the past week. Okay, so that was the first development that we saw. And the other key development that we saw is that there are now increasing concerns about a global recession. And with that, some of the more trade-sensitive sectors, such as the logistics assets, have seen the share price actually coming down because of uncertainty towards some of these sectors. And some of these concerns have actually faded over the past few days. With the tariffs actually being paused, we have seen a recovery in the REIT sector in the last 2 days. Okay, so this in a nutshell is actually what has happened and what is actually driving a lot of the volatility in the REITs. We'll look at each of this in more detail. So I started by talking about the Federal Reserve interest rates expectations and what they have done in 2025. So like I shared earlier, while this was a very big driver for the REITs, especially in the middle of 2024, it has become less of a factor in recent months because of the fact that the Fed has effectively kept interest rates unchanged in their meetings so far this year. And with that, some of the other global developments have been a more significant driver for the Singapore REITs. Okay, with the Fed actually cutting interest rates, what we have seen actually having the most significant impact would be the short-term government bond yields. So I've looked at the US 1-year government bond yield, and what we see here is that with the expectation that the Fed will cut interest rates, we have seen a very sharp fall in the 1-year government bond yield starting from the middle of last year. And what we have seen since then is that there's a slight rebound with the elevated inflation rates that we have seen since then. But generally, they've been maintained at the 4% level for the US 1-year government bond yield. Okay, so this is more or less in line with what we have seen for the US Federal Reserve interest rates. And the short-term bond yields are probably the best reflection of that. So if you are an applicant of the Singapore 6-month T-bill, 1-year T-bill, you're probably aware that the bond yields have actually come down over the last 6 months, such that even for the Singapore 6-month T-bill, now we are looking at rates that are below 3% compared to rates that are above 4% at the peak. Okay, where we have seen a lot more movements is actually in terms of the longer term bond yields. So this is the US 10-year government bond yield, and we have seen actually very big movements in the 10-year bond yield over the past few months. Okay, so this chart would actually show that the 10-year government bond yield is still fairly elevated, and the decline is not as significant as what we saw for the 1-year bond yield. Okay, so what we have seen here, the 10-year bond yield fell to about 3.6% after the Fed started cutting interest rates in September last year. Then it rebounded all the way to as high as about 4.8% as inflation actually stayed high. And then it came off this year with the gradual slowing down of the economy. But what I wanted to point out from this chart is that it's had a very significant bounce in the last 1 week, from 4% to 4.5% just within the time span of 1 week. And that is one of the key factors that brought down the performance of the Singapore REITs. Because if your government bond yield is able to offer you a higher yield, what this actually means is that investors may not want to be taking on so much risk by buying Singapore REITs. Okay, so as the bond yields have started to come down a bit over the past few days, we have also started to see the share price of Singapore REITs rebounding slightly in the last few days. Okay, so likewise, we have seen for the Singapore 10-year government bond yield, it's been very volatile as well. We saw this very sharp spike just last week to above 2.7%. And then in more recent days, it's come down back to about 2.55%. Okay, so this is something that I'll continue to monitor very closely because if the 10-year government bond yield is going to be higher, that may make some of these risk assets, such as Singapore REITs, appear less attractive to investors. Okay, so really at the end of the day, this is driven by a lot of the uncertainty towards the tariff. So we have seen actually Trump announcing tariffs across many different countries. Initially, it was 34% on China, EU 20%, Vietnam 46%. Some of these tariffs have since been paused, except for those relating to China. And I think that is the key reason why we have seen some of the bond yields actually starting to come down as a result of this relief by investors. But generally, I think the backdrop that we are in at this point in time is that the uncertainty is still very high. Okay, what would I actually track to be able to understand the level of uncertainty in the market? This is actually this indicator called the Global Economic Policy Uncertainty. And I think what is very interesting to me here is that if I look at this level of uncertainty, it's actually as high as what we saw during the COVID-19 period. Okay, so if you remember the COVID-19 period, things were very uncertain. We did not know how long the lockdowns will actually extend for. We did not actually know how governments are going to react to the pandemic. And as a result, we saw a lot of uncertainty in the global markets. Likewise, at this point in time, because there's no certainty as to whether Trump is going to continue raising the tariff, whether there's going to be retaliation by the trade partners. So from the uncertainty index perspective, it's actually as high as where it was during the COVID-19 period. So with that, we are seeing a lot of very sharp movements in terms of the government bond yields, and that is also leading to a lot of volatility in the performance of the Singapore REITs. Okay, so those are some of the global drivers that we have seen. We may not actually look at some of these indicators on such a close basis, given that we might be looking at the individual REITs that we are holding on to. But I just wanted to start with this discussion so that all of us are on the same page around what is driving the performance of Singapore REITs. So maybe just as a quick recap, generally we have seen the Fed cutting interest rates. This was since September last year, and that has actually led to the fall in the short-term rates. Likewise, what we see for the Singapore T-bills. And in a way, how this is going to impact the Singapore REITs is that this is generally positive because it will help to lower the borrowing cost. But on the other hand, we have seen that the longer term government bond yields have actually moved up, especially in the past week. And that is also helping that is actually leading some investors to buy other asset classes, which are seen to be relatively safer, such as the Singapore savings bonds, and making assets such as the Singapore REITs appear less attractive. Last but not least, because of the concerns around global recession, it is also leading to questions as to whether some of these real estate assets, such as logistics assets, office assets, will actually see a slowdown in demand. Okay, so because there are quite a number of different factors here, as a result, we are seeing the volatility in the share prices of Singapore REITs, because at any one point in time, some of these factors may play a larger part compared to some of the other factors. Okay, so as we go through our subsequent slides, I will look at some of these individual drivers, and then we'll see how they will actually impact the REITs going forward. Okay, so I've finished the macro discussion. At this point in time, maybe I'll just get some reaction from our participants here. If you think the pace is okay, please put a yes in the webinar chat. If you think I should go slower, please let me know as well so that I can moderate my pace to be able to accommodate our participants here tonight. Okay, I see some responses here. Most of them have indicated yes. So I suppose my pace is okay for everyone who has joined us tonight. And what I'll do is I go on to this next section, which is then to look at the individual REIT subsegments and whether they continue to have healthy fundamentals amid some of these global developments that we have seen. Before I go into the fundamentals of the REITs, just wanted to do a very quick recap because at Beansprout, we always want to be sharing a framework for you to be able to look at the investment so that we are not doing this in a very ad hoc basis. We know what we are actually keeping a lookout for. I wanted to just do a quick recall around how we would look at analyzing Singapore REITs using our checklist. So the few key factors that I'll always be keeping a lookout for, I will look at the fundamental strength, whether the REIT is supported by good quality assets, good quality sponsors that will allow them to be able to earn a good rental income. Two, I'll look at the financial strength of the REIT to make sure that their debt levels are not too high, they are able to meet their interest payments, they are able to refinance their debt, and that is the financial strength that I'll keep a lookout for. Last but not least is the valuation of the REIT. Effectively, I want the REIT to be trading at attractive valuation. I don't want to be overpaying for the REIT. I want the REIT to be able to pay me a good and sustainable dividend yield so that I can earn a good dividend income from holding on to this REIT. Okay, so three things: fundamental strength, financial strength, as well as valuation of the REIT. Okay, and what I wanted to start with is to look at the fundamental strength of the different subsectors so that we know whether the REIT is able to earn a good rental income. Okay, so a few different REIT subsectors. These are the key ones: retail, hospitality, office, industrial, and I'll go through each of these subsectors in more detail. Okay, I'll start with the one that everyone is always most familiar with, which is retail REITs. It's something that we are able to relate to because when we go to the shopping mall, we can see how the mall is actually performing. When we are actually doing our F&B, having our dinner, we can actually see how some of these F&B outlets are actually performing. Okay, so what I wanted to share would be the retail sales numbers in the Singapore market, because at the end of the day, how the malls actually perform is actually driven by how much people are spending. And this is what I'll track, which is the retail sales figure in Singapore. What we have seen here is that generally in the first 2 months of the year, I would say that the retail segment has been stable. While we saw this decline in February, we actually saw that the January number was more elevated. Why is that the case? Because if you recall, we had an earlier Chinese New Year this year in January rather than February last year. And as a result, consumers brought forward their spending. We did our Chinese New Year shopping earlier, and that helped to boost the January number. Okay, so as this spending was actually brought forward, what we saw in the February number was that it was generally weaker compared to the previous month. Okay, so what we saw here is that on a year-on-year basis, the total retail sales for the month of February was actually down by about 4%. But if you were to look at it from a seasonally adjusted basis, so adjusting for the Chinese New Year impact, then it was about stable with the total retail sales up by 3%. Where we saw the greatest volatility would be those that are impacted by Chinese New Year. So things like your supermarket and hypermarts, because people were buying their Chinese New Year goodies earlier in January rather than in February, we saw that this actually dipped in the month of February compared to January. Okay, I would say that across the different segments, this is not a segment that is actually growing particularly well. Given that while we are seeing that the economy is still fairly stable, I think because of the more cautious outlook that most consumers actually have, you probably don't see people spending very much these days. And as a result, the retail sales would be stable. At the same time, because the economy is not in too bad a shape as well. So the spending on some of the household items, things like your groceries are still there, while some of the cutback may be more significant in the luxury goods segment. Okay. So that's the retail landscape that we are in. And with that, we are saying that the rentals for the retail malls are still generally stable. If I look at the retail space rental index, effectively since the sharp fall that we saw during the COVID period, it has stabilized over the past few years. In fact, if I look at the fourth quarter data, it was up just by about 0.5% compared to the previous quarter. So nothing particularly exciting here within the retail segment. As the retail sales has been fairly stable, the rentals that the mall operators have been able to earn have been fairly stable as well. If I were to look at the vacancy rates of the malls, also fairly stable. So if you go to a mall today, especially for some of the more well-run malls, you see that they are generally occupied. You don't see a lot of vacant space that's available. So this is likewise reflected in the URA data, where the vacancy rates, especially for some of the malls that are owned by the REITs, have actually been fairly low. So what I like to do for the retail segment is always look at the largest owner of retail assets in Singapore. So I'll look at the latest updates by CapitaLand Integrated Commercial Trust. Some of you may be shareholders of CapitaLand Integrated Commercial Trust, but even if you're not, I would often go back to their slides to look at their recent performance. So what's interesting to me here is that if I look at the occupancy rate of their retail portfolio, what we see for the occupancy rate is that it is fairly high, 99.3% as of 31st December 2024. So that to me is effectively close to full occupancy already. Okay. And if I were to look at the rental reversions for the retail portfolio, it is close to 9% positive reversions for the whole of 2024. Quite evenly split between the suburban malls as well as the downtown malls. So that is quite consistent with what we have seen for the overall retail sales numbers in Singapore, where it is fairly stable. And with the assets that they have, they've been able to enjoy a high occupancy as well as positive rental reversions. So generally for the retail segment, given what we have seen for both the occupancy rate as well as reversions, it is seen as one of the most resilient sub-segments within the entire REIT space, which is why typically when there are concerns about economic slowdown, investors would tend to look at the retail segment as a place to be hiding, given that it is seen to be more defensive. Okay. So that is for the retail segment. Next, I'll look at the office segment. Sorry, before that, I'll look at the hospitality segment, because that is actually something that is linked to the retail sales spending in Singapore. Okay, so some of you may hold on to the hospitality REIT. So we just do a quick recap here around the tourist arrival growth in the Singapore market. So in 2024, we saw this continued recovery in tourist arrivals into Singapore. And a big part of the recovery in 2024 was driven by the influx of Chinese tourists. So because of the exemption from visa requirements, that actually helped to boost the tourist arrivals into Singapore last year. That pace has continued into January this year. And I think generally what we have seen is that as the global travel continues to rebound, that has helped to improve the occupancy rate in hotels in Singapore, as well as the revenue per available room in the Singapore market. Okay, so this is what we see for the revenue per available room. effectively what it tells us is how much revenue the hotel operators are able to make for each hotel room that is available. And what we have seen here is that for February 2025, at about $230, slight improvement from what we saw from January this year. So as the tourist arrivals continue to recover, that's also helped to keep the revenue per available room fairly stable. So what are the expectations for tourist arrivals into Singapore in 2025? Last year, we saw the total tourist arrivals into Singapore increasing by 20%. So we reached 16.5 million tourist arrivals last year, which was at the top end of the STB's forecast. For 2025, STB expects a further improvement in tourist arrivals. Some of it is driven by the events, by the concerts that we continue to see. We have Lady Gaga performing in Singapore in a few months' time. So that is continuing to drive the recovery in tourist arrivals. And the STB is expecting that the total arrivals into Singapore this year would be in the range of 17 to 18.5 million. Okay, so that will represent a continued recovery in the tourist arrivals into the Singapore market. Next, we have got the office segment. So compared to the resilience that we have seen for the retail segment, the office segment is definitely one that is more vulnerable to economic changes. What we have seen here is that the office rental index actually fell by about 1% in the fourth quarter compared to the previous quarter. So even before the trade tariffs actually came in, we are starting to see some weakness in the office rental market. There are two drivers behind this. One is from a demand perspective. We are not seeing as strong a demand growth compared to the previous years. And secondly, from a supply perspective, we are also seeing more supply in office space coming into the Singapore market. So what we have seen here is the vacancy rate for the office space in Singapore. On average, we are looking at about a 10% occupancy vacancy rate for the office space that's in Singapore. And I think what is interesting from this chart is that those that are in downtown core, those that generally seem to be of better quality, have a lower vacancy rate compared to the remaining office space. So what this generally means is that with the general weakness that we've seen in the office market, the tenants are also becoming more picky. If they have two same office space to be choosing from, they tend to prefer going for the better quality office space that is then located at downtown core or at Orchard compared to the remaining office space. So the tenants are making use of this opportunity to upgrade their office space as well. Okay, so I shared earlier that one of the key reasons for the decline in office rents is because we are seeing more supply that's coming through. So actually what we have seen is that over the past few years, a fair bit of supply has actually come in. And this is actually above the increase in demand. Okay, so using 2024 as an example, the net supply growth was at 0.3 million square feet versus the growth in demand, which was just at 0.2 million square feet. Okay, so the supply growth actually outstripped the demand growth. But what is also interesting is that if I were to look at the coming years, there continues to be a lot of new supply that's coming into the market. In 2025, for example, we've got Keppel South Central, which is actually coming up in Tanjong Pagar. That is close to 600,000 square feet of space. So effectively, that is a fairly large amount of supply that's coming through. And if the demand growth is not able to absorb this growth in supply, then we might see further weakness in terms of the office rents. Okay, so compared to what we have seen for, say, the retail segment, the continued growth in the hospitality segment, the office space is actually one area where we are already starting to see some weakness, even before this escalation in terms of the trade war. Next, I'll go to the industrial segment. Given the trade war, I think there's one segment where a lot of investors have concern on the demand for business parks, on the demand for logistics space, and we'll see what is actually the fundamentals of this sector. Okay, the good news for the industrial segment is that it is coming through a few years of fairly resilient performance. So if you recall, after the COVID period, we actually saw a very strong demand growth for the industrial assets. That's because of the need for supply chain diversification. That's because of the growth in e-commerce, which led to very strong demand for some of these industrial assets. Okay, so over the past few years, we have seen the rents for the industrial segment actually going up fairly sharply. But the growth has actually started to slow down in recent quarters. And in the fourth quarter of 2024, actually we saw the slowest pace of rental growth in the industrial segment in the Singapore market. So if I were to look at this all industrial property rental index in the fourth quarter, it grew by just 0.5% quarter on quarter, or in other words, compared to the third quarter of last year. And that actually represents the slowest pace of growth in close to 4 years. Okay, so this is what we see in the different subsegments. So for example, if I were to look at the single user and multi-user factory space rental index, there is already some slowdown in terms of the rental growth. And more significantly, if I were to look at the business parks rentals, they have effectively been coming off since early last year. So if I were to look at the business park in particular, this is one area where there is a significant concern given the very high vacancy rates that we have seen. Earlier, I shared that the vacancy rate for office space is about 10%. But if I were to look at the vacancy rate for business parks in Singapore, in the most recent quarter, it has gone up to 22%. So that is a fairly elevated level of vacancy rate for the business parks. And I think that has impacted quite a number of REITs that have exposure towards the business park segment. Okay, so this is a space that I'll continue to watch because if we are not able to find new tenants for these business parks, then the rents that the owners of these business parks are able to earn will continue to be under pressure in the coming quarters. The last point that I wanted to really share would be the REITs with overseas assets. Okay, so I think what we have seen generally as a trend over the last few years is that a lot of the REITs have acquired overseas assets as a way to be able to diversify their portfolios. So while a lot of what I shared earlier relate to the Singapore assets, where some of the performance has been more resilient, what we have seen impacting the REITs in the more recent quarters would be the performance of some of their overseas assets. Okay, so I wanted to bring up this example, which is Mapletree Logistics Trust, because a commonly asked question is actually around the performance of Mapletree Logistics Trust, which is typically seen as a REIT with a very strong sponsor, which is Mapletree. And if I were to look at the performance of the logistics assets in Singapore, actually they've been very strong based on the data that I shared earlier. But for some of the holders of Mapletree Logistics Trust, what we have actually seen is the share price of MLT actually coming off over the past few months, and now actually close to a multi-year low. So what I wanted to point out here is, if I were to look at the performance of MLT, actually there is divergence in terms of the performance across their assets. And China is one area where the demand for the logistics assets has been fairly weak. If I were to look at the rental reversions in Singapore, it is healthy in the most recent quarter. It was at positive 7.5%. But if I were to look at the China logistics assets, for MLT, it was actually negative 10.2% reversions. Okay, so that was a drag towards the portfolio. In the most recent quarter, the entire portfolio rental reversions was positive 3.4%. Excluding the China assets, it would actually be positive 5.4%. Okay, so that is something that is important to take note of, in that we must not only keep track of the performance of the assets in Singapore, but especially with the escalation in the trade war, some of the REITs with significant overseas exposure, particularly those in the logistics space, would be something that we need to keep a very close lookout for, because they can be impacted by some of these demand shifts that we are seeing. Okay, so that relates to the fundamentals of the REIT. I think the additional point that I also want to make is really around the currency impact. So even if the REITs are able to enjoy similar rents for their overseas assets, because the Singapore dollar has been very strong against some of the other regional currencies, we have actually seen that when these rents are then translated back to Singapore dollar and paid out to unit holders in Singapore dollars, the distributions are not as strong as what it was in the past because of the weakness in the regional currencies. Okay, so I just brought up two examples here, which are very distinct. The first is the Indonesian rupiah. Recently, we saw that the Indonesian rupiah went to a low compared to the US dollar as well as the Singapore dollar. So that's something to keep a lookout for, because for the REITs with exposure to Indonesia, effectively when these rents are then being brought back to Singapore, that will be having a more negative impact compared to if the rates were actually stable. Next, we look at, say, the Japanese yen. Over the long-term trend, the Sing dollar has also strengthened against the Japanese yen, even as the Japanese yen has started to stabilize in the past few months. Okay, so using just these two examples to highlight why some of the REITs with predominantly Singapore assets have done better compared to some of the REITs which may have more overseas assets. Okay, so then the key question would be, having looked at the macro, having looked at the fundamentals across different asset classes, what should we think about as REIT holders or as investors who are interested in buying the REITs at this point in time? Okay, so I think the first point that I would take note of is really the continued interest rate uncertainty. So I started by sharing how a lot of the economic backdrop is highly uncertain at this point in time. So I think how it's being reflected is that in terms of the interest rate expectations, it remains very uncertain as well at this point in time. So this is the latest expectations on interest rate cuts by the US Federal Reserve. At this point in time, investors are expecting 4 further rate cuts in 2025. So while we have not seen any rate cuts this year, and likewise, the expectation is that the Fed will keep interest rates unchanged in the May meeting. But based on what investors are expecting now, we may see one potential rate cut in June, one in July, one in September, and then one more in December to bring the total number of rate cuts to 4 this year. But I think because investors are still not entirely convinced on these rate cuts, plus on top of that, there's still questions about whether this will bring down the bond yields. As a result, we have seen that the share prices of the Singapore REITs continue to be depressed until there is more certainty about these rate cuts, as well as how that will help to bring down the government bond yields. Okay, so that is the first thing that I'll continue to keep a lookout for. I think the other interesting observation to me is that with the very varied macro outlook that I shared earlier, with the very varied performance across the different REIT subsectors, we have actually seen very significant divergence in terms of the distributions of the Singapore REITs. Okay, so using the most recent reported distributions as an example, what is an interesting observation to me from this chart is that more REITs actually cut their distributions compared to REITs that were able to raise their distributions. Okay, so what this actually means for us as investors is that we want to have these REITs that are able to grow their distributions, because otherwise we are continuously face the risk that our dividend income is going to be impacted negatively. So what is then important is that we want to be able to find the REITs that are able to at least maintain their distributions, or even better, grow their distributions against the backdrop that I described earlier. Okay, so then how do we actually find which are the REITs that are able to grow their distributions? I'll then go back to this checklist that I shared earlier. It is about being able to find the REITs with better fundamental strength. And hopefully from the discussion earlier, we would have a better idea on which are the REITs that are in segments that are a bit more resilient. So as an example, we saw that the retail segment has been more resilient compared to other subsegments. So likewise, this is what we see in this chart as well. If I look at some of the retail REITs, particularly the ones that have got exposure in Singapore, Fraser Centrepoint Trust, they have been able to keep their distribution stable. CICT able to keep their distribution stable. Okay, so that is likewise reflected in terms of the distribution of the REIT. Okay, but on the other hand, if I look at some of the REITs with exposure towards the segment that are having some kind of headwinds, so using Suntec REIT as an example, we actually see this decline in terms of its distribution in the most recent quarter. Okay, or for example, I shared earlier that some of the REITs with exposure to overseas markets would see some of their distributions being impacted as well. So some of the examples here, for example, we saw that for CapitaLand China Trust as an example, because of the weakness in the Chinese yuan versus the Sing dollar, even as some of the retail assets that they have in China has been fairly resilient, when they are translated to the Singapore dollar, we actually see the impact towards their distributions. Okay, so that is the fundamental strength that we need to keep a lookout for, because that will then impact whether the REIT is then able to keep their distributions. Next is really around the debt levels, because the REITs with better debt management, better capital management, lower levels of debt would not be as impacted by the high interest rates that we are now seeing in the market. And on the inverse, the REITs with fairly high levels of debt actually face higher interest costs, which is also impacting their distributions. Okay, so going back to this chart once again, we see that some of the REITs with actually lower gearing levels have actually been able to maintain their distributions, while some of the REITs that have got higher level of debt also are being impacted because the higher financing cost is impacting their distributions. So another example here, we see Suntec REIT is one of the REITs with leverage ratio that's above 40%. Likewise, Lendlease REIT also with a leverage ratio of above 40%. And what we see here is that the higher financing cost is actually impacting their distributions. Okay, last but not least, one of the key things that I'll keep a lookout for is the price to NAV valuation, or the price to book valuation of the REIT. Okay, so if you had noticed what we have been putting out over the past week, we recently put out a piece looking at some of the REITs that are trading to relatively low price to book valuation compared to the historical average. So that is one of the ways that I can start looking for interesting REITs to add to my watch list. Because if the REIT is trading at a depressed price to book valuation, but still able to maintain their distribution, have a relatively low debt level, then I may be more comfortable buying this REIT compared to other REITs. Okay, so these are some of the key things that I will keep a lookout for. and I will actually demonstrate how to look at some of these things using the Beansprout stock tool. Okay, so with that, I will go to some of the examples and share how I would typically look at the REITs and how they fare on some of these indicators. On Mapletree Logistics Trust, we have seen this very sharp fall in the price over the past few months. And I think what we have seen here is that even if I extend it out longer towards a 5-year period, Mapletree Logistics Trust is actually trading close to its multi-year low. So what I would actually do is to look at one of the first things I'll look at is the price to book valuation. Okay, so I mentioned in the valuation that it is one of the things that I'll keep a lookout for. So if I were to look at the price to book valuation of Mapletree Logistics Trust, now at about 0.85 times price to book, that is actually below the historical average valuation of Mapletree Logistics Trust. Okay, so how I use this chart is that if it's trading above the historical average, and particularly if it's trading close to one standard deviation above the historical average, I'll probably not think that there's going to be significant further upside for this REIT because it's really trading above the historical average valuation of the REIT. Okay, but if it's trading below the historical average, trading below the sector average, then it is something that might actually be worthwhile looking at from a price to book valuation perspective. Okay, so that's the first indicator that I'll keep a lookout for. The second thing that I'll keep a lookout for would be the dividend yield. Okay, so what I'll do is to look at this effectively. Now the dividend yield of Mapletree Logistics Trust is actually close to one standard deviation above the historical average. The historical average is at about 5.5%. The sector average is at about 6.2%. So based on both of these indicators, it's actually above both the historical average as well as the sector average dividend yield. What I would then want to see is whether the REIT is able to maintain the dividend payout, because if it can, then it means that that is a fairly attractive dividend yield. Okay, but what I see here for Mapletree Logistics Trust, the dividend payout actually declined and is expected to decline further. This may be because of the concerns around the negative rental reversions in the China market and how that's going to impact its distributions. Okay, so I think we will then have to weigh as to whether we think that the distributions will decline significantly, and then see whether this 7% dividend yield still looks attractive enough to us. Ideally, we want the REIT to be able to give a high dividend payout and be able to maintain these distributions. Okay, so maybe I'll use another example of a industrial REIT, maybe using Frasers Logistics and Commercial Trust as an example. Okay, so like what we saw for Mapletree Logistics Trust, also trading at a multi-year low. And if I were to look at the valuation of Mapletree Logistics Trust, of Frasers Logistics and Commercial Trust, effectively the price to book valuation is below the historical average. And in fact, it is close to the COVID low that we see here. Okay. So what this means is that the risk reward to me is probably better because it's really close to the COVID low and maybe pricing in some of this uncertainty that we discussed earlier. Okay, so next we look at the dividends of Frasers Logistics and Commercial Trust. So once again, the dividend yield is above the historical average. In fact, it is also above the sector average dividend yield. Okay, and if I were to then look at the distributions of this REIT, unfortunately, the distributions have come off as well. This is likely because of the depreciation of the Australian dollar versus the Sing dollar. So even though some of these logistics assets may be performing well, because a big part of the asset base is in Australia, so that is actually impacting the distributions of Frasers Logistics and Commercial Trust. Okay, so just to confirm, yes, that's what I see in terms of the revenue breakdown and asset breakdown in that because the majority of its assets are in Australia, so because of the weakness in the Australian dollar versus the Sing dollar, that's actually impacting the distributions of FLCT. So maybe then I go to another industrial REIT. In this case, I'll bring up 𝗵𝗲𝗄𝗃 REIT, which is one of the REITs that has been able to grow its distributions in the most recent quarter. Okay, so effectively what we have seen here is that the distributions have stabilized for 𝗵𝗲𝗄𝗃 REIT. And hence, if I was to look at the dividend yield of 𝗵𝗲𝗄𝗃 REIT, trading now at about 7.3% dividend yield, which is close to the historical average. So likewise, if I were to look at the price to book valuation, effectively, the price to book valuation is above the historical average, but that is being offset by the dividend yield that we see for the REIT. Okay, so I've gone through a number of REITs here. Maybe I'll just stop here to see whether there are specific REITs that you want me to be going through. You can put it in the chat and then maybe I'll just go through one or two more examples. Okay, I see Mapletree Industrial Trust, 𝗕𝗲𝗿𝗀𝗀𝗃𝗲 REIT. Okay, quite a number of questions relating to Mapletree Industrial Trust. CapitaLand in the India Trust, CapitaLand Ascendas REIT. Okay, so I think since I brought up Mapletree Logistics Trust earlier, I think it's then also fair that I discuss Mapletree Industrial Trust. Okay, so I think for Mapletree Industrial Trust, we also see the share price actually trading close to the multi-year low. And if I were to look at Mapletree Industrial Trust, I think the key issue really relates to the assets in the US. Okay, so the US is actually now close to half of its portfolio. And I think that is where we have seen some uncertainty around the demand, particularly for the data center assets. I think the other thing that has not been favorable for Mapletree Industrial Trust is that while the share price has come off, from a price to book perspective, it's actually still trading at both above the historical average as well as above the sector average. So now at 1.1 times price to book, the historical average is 1.08 times, the sector average is 1 times. So while the share price is at a 5-year low, the price to book valuation does not look particularly attractive compared to the historical average as yet. Okay, so this in contrast to what we saw earlier for Mapletree Logistics Trust, in that for Mapletree Logistics Trust, the share price has come off close to a 5-year low. And likewise, in terms of the valuation, the price to book valuation of Mapletree Logistics Trust is also at the low compared to the historical average. If I were to look at the dividend yield of Mapletree Industrial Trust, it is now above the historical average, but compared to the sector average, given that quite a number of REITs are now trading at fairly attractive dividend yield, the 6.5% for Mapletree Industrial Trust is not particularly high compared to the sector average. Okay, so I think that is something that I will bear in mind if I am trying to look for stocks that have come off significantly, trading at low price to book valuation. Then maybe the Mapletree Industrial Trust may not be that attractive compared to some other REITs that we see in the market today. So how will we be able to look for some of these REITs? We have this screener on the Beansprout website where you'll be able to screen for Singapore REITs and compare what their current price to book valuation is. So effectively, this is one of the starting points that I will come to look at which are the REITs that are trading at the lowest price to book valuation. So as an example here, OUE REIT 0.47 times price to book, CDL Hospitality Trust 0.51 times price to book, Suntec REIT 0.55 times price to book, CapitaLand China Trust 0.55 times price to book. Okay, so if I'm looking at really deep value Singapore REITs, I'll look at those that are trading at a very significant discount to the book value and start looking for REITs from there. Okay, I can continue looking through this list to look for REITs that are then classified as large cap REITs. So the first one that comes out here is 𝗵𝗲𝗰𝗙𝗃 Asia Commercial Trust, which has also come off fairly sharply. Then maybe Frasers Logistics and Commercial Trust, which I went through earlier. And if it's a REIT that is then able to maintain its distributions, has a low debt level, and offer a dividend yield above the historical average, it might be something that I'll do more work on to look at whether it is something that I will put my money into it. Okay, so hopefully that provides you with a framework as to how to screen for Singapore REITs. Okay, so I will take some of the questions that you have since it's now 8:30. Should REITs trade at a bigger discount compared to historical average since the REIT environment is different? So this is a very good question. I think I wanted to share the macro backdrop at the start because I think the key point to realize is that the environment that we are in now is very different from the environment before 2020, where we were in a very low interest rate environment, which made it very conducive for the Singapore REIT sector. So now we are in a period of interest rate uncertainty. We are in a period of economic uncertainty, which means that the REITs will likely continue to see share price volatility. And even for the REITs that are having better quality assets, we might not see them trading to as high a valuation compared to in the past. So going back to the framework I shared earlier, we want to have the REITs with good quality assets. The REITs must have a strong enough balance sheet to be able to withstand this uncertain interest rate environment that we discussed. And most importantly, in terms of the valuation, we do not want the REITs that are trading at very elevated price to book valuation. We want the REITs that are able to pay us a high and sustainable dividend yield because that gives us a larger margin of safety towards holding these REITs. The key takeaway is really there's continued economic uncertainty. While we have seen a pause in the tariff, the overall economic outlook still remains highly uncertain, and that will continue to impact the share prices of the REITs. So I discussed a few ways that this will impact the REITs. First and foremost, we have the tariffs that may lead to an economic slowdown, and some sectors are going to be more vulnerable to an economic slowdown compared to the others. At the same time, we also have this volatility in bond yields, such that it's no longer sufficient just to be looking at the Fed interest rate cuts and expecting that the Fed interest rate cuts will feed through to lower bond yields and benefiting the REITs in general. Okay, so quite a number of different things that we then need to keep a lookout for and will impact the REITs in different ways. So we also look at the performance of different REIT subsegments, including retail, hospitality, industrial, as well as office. And what we have seen is that there is a divergence in terms of the performance, where some of the subsegments like retail are more resilient, while other segments such as office, even before the escalation in the trade war, we are already seeing some form of weakness. So depending on the exposure there, the REITs may be impacted in different ways. On top of that, because a lot of the REITs have exposure to overseas assets, again, because they may not be as resilient compared to the Singapore market. I've used logistics as one example, where in Singapore, the logistics segment has been resilient, but in a market like China, we are already seeing negative rental reversions. On top of that, because the Sing dollar has been very strong, as the rental income from these overseas assets are then being exchanged back to the Singapore dollar, it may not then translate to as high a distribution for unit holders. So what this means is that I would be looking for REITs which are able to grow or maintain their distributions and trade at an attractive valuation, whether is it from a price to book or from a dividend yield perspective. And what we have seen is that the healthcare and retail REITs with predominantly Singapore assets are typically seen as the ones that are most resilient, especially in the face of an economic slowdown, as well as volatility in terms of your interest rates, as well as your exchange rates. Okay, so those are the key things that I'll continue to keep a lookout for, especially since there's likely still going to be a lot of news flow relating to the tariffs in the coming months. But hopefully with the framework that I've shared, it can help everyone who has joined us for the webinar tonight to be able to analyze the REIT sector much better and to identify opportunities in the REIT sector much better as well. Okay, so if you would like to continue to stay updated on the Singapore REITs, do follow us on our different social media channels where we'll continue to provide you with updates on the Singapore REITs. With that, I'd like to thank you once again for joining the webinar tonight. Have a very pleasant evening, and I hope to see you again soon. Thank you.